Planning for retirement is tricky at the best of times because it is beset by uncertainties both known and unknowable. High valuations are one of the known problems, but that doesn't make them easy to deal with. Heck, I've been openly concerned about high valuations since 2020. Markets can stay lofty and irrational for a very long time. The US stock market is trading at worrying levels based on a variety of value factors. For instance, the S&P 500 index is trading at a cyclically adjusted price to earnings ratio developed by Robert Shiller near 40, which is approaching the top of 44 in late 1999. Similarly, the price index's price to sales ratio is approaching its 1999 high. A broader composite measure that includes many different market factors indicates that the US market's valuation is at record levels. Let's reiterate that while valuation tends to be a poor near term market predictor, it's done a pretty good job over the long term when markets get this high, and the medium term future is downright frightening. As things stand, it seems likely that the US stock market will generate unusually poor average real returns over the next decade or so. Back to when I was first expressing my concern in 2020, the CAPE was trading at around 35. And historically, when the CAPE hits 35, the annualized return for the market over the ensuing decade is close to zero. Since 2020, the US market has more than doubled. Extrapolating the data, that means that it could drop by more than half over the next 4 years or so. That's frightening for anyone, but it's absolutely terrifying for retirees, since they won't be able to make up any shortfalls with new money. They also don't have a long time horizon to wait for markets to rebound. This challenge, known as sequence of returns risk, is a bugaboo that many don't contemplate because they haven't experienced it in a major prolonged way. That's an example of recency bias. People become complacent and set expectations for the future based on the recent past, and that's risky. For example, people retiring in the early 1970s suffered from the crash of 1973, then stagflation, and then a recession in the early 1980s. This set of bad news stories, laid end to end, depleted many portfolios before the good times returned. And by that time, portfolios had dwindled to the point where people couldn't recover. Many people, including me, fear that stagflation may be making a comeback. The second example is the Nikkei 225 in Tokyo. It hit an all-time high at the end of 1989, and it only hit new highs last year. When you say you take a long-term viewpoint, just how long are you thinking?